Ready.
Okay, we can start.
Hi, my name is Zaki.
I'm Pranav,
I'm Justin.
I'm Rahul.
And
and yeah,
well, this is a stock market performance analysis project. Go ahead and hit next. So just like in our proposal that we discussed previously, we're going over the NASDAQ index fund, which is one of the most followed stock market indices in the United States, which unlike the S&P and the Dow Jones, which is more selective, it measures larger amounts of companies, so it takes into account economical and technological trends. So analyzing the historical performance will allow us to gain a better understanding of the market, and that can include recessions, interest rate changes, global crises. Go ahead, hit next. And so our first question was, over the last 5 years, what were the key trends? And if you take a look at the first half of 2020 on the chart, you can see that there was an early 2020 decline because of COVID-19. And then there was a huge just downtrend in all of 2022 when and Russia were going to war. There was interest rate hikes. There was a lot of geopolitical tensions and also rising inflation. So it was just a bad year for us. And then you also see just kind of in every year, halfway through the year, there's always notable upticks because it's the summer months, everybody's going on vacation, everybody's having fun. And then also in the last quarter of every year, you see the Santa Claus rally because everybody's again happy because it's holidays and they're spending their money, they're also buying stocks and everything. And then of course the latest surge, which is our post-election surge from President Trump winning this time around. So these kind of things tell us what the key trends are. Go ahead, hit next.
okay. So the second question we were looking into was, can we forecast the future stock prices using time series models? And for this, I took an approach of a lot of feature engineering and deriving features from the data we already have. Um, then I visualize the graphs to see what we are looking at and understand the market behavior. Um, then we uh, then we tried experimenting with a lot of models, but XGBoost was the with technical indicators for price prediction was the model that performed the best. Other models that we used were linear regression and decision tree models, but XGBoost is basically a combination of multiple decision tree models. So that was the choice, and the evaluation of our model was through cross validation and RMSE, root mean square error metrics. And why did we pick XGBoost? XGBoost effectively captures nonlinear patterns in stock data, making it ideal for predicting complex market trends. It handles engineered features like moving averages, momentum, and volatility with high precision and efficiency. And as you can see in the graph on the right, those are the moving averages, and those were some of the features that I used for my models. This is the resultant graph of the prediction model that I got. So I have a graph for all the 5 years, but this is a zoomed in part, and the dotted orange line is the dotted orange line is the prediction line, and the hard blue line is the actual price. And as you can see, it does trace through the along the blue line, but I don't think we can use this model for like day-to-day trading or high-frequency trading, but it does have an idea of what the stock price would do in future. Not the exact, but it does have. Um, Looking at the accuracy of it, looking at the previous graph, we cannot understand what the exact accuracy of it is, but these are the two ways I thought I could share the accuracy of my predictions. And on the left, we have a line graph um, in between predicted values and actual values. And the line in the dotted line in the middle represents the accuracy. So if all the dots are along that line, that means zero accuracy. And if they're farther away from the red line, that means it's inaccurate. And as you can see, most of the dots are on the red line. So that's a positive. On the second graph, as you can see, there is an RMSE error, target mean and target range. So this is a comparison between the error that we were getting and the actual values of stock. So even if the stock was at like a 13,000 price range, the error would be in the hundreds, like 130, 140. So I think that makes the model pretty accurate. So for future studies, uh, we could incorporate GDP growth, inflation, and other external factors. And I would also like to try using LSTMs or some models like transformers, which have memory for trying to solve this problem.
With question 3 in mind, the industries that had the most volatility during economic downturn. Again, we can take a look at the main key trends in the historical performance and then take a look at that. So for COVID-19, the volatile sectors at that point were the financial and the consumer discretionary. Consumer discretionary, it's like hotels or the non-staple things in our everyday lives, going to hotels, swimming pools, water parks, luxuries of life. And so those experienced a high volatility due to market uncertainties and liquidity concerns. We weren't able to go out much and that kind of stuff. So those sectors suffered a lot and they were volatile. And then again, there was 2022, like I said, it was a very big down year for us with all the global and geopolitical tensions and everything like that. So again, our consumer discretionary was the most volatile this year. And then also following closely was the technology sector, because this was kind of the beginning when NVIDIA and a lot of AI companies started changing a lot of the economy and institutions' minds. And so the AI boom started showing up, and then it would kind of make its mark in 2024, which you can see that towards the end of the chart as well. That blue line technology is the most volatile. So this year, that's been the most volatile because of President Trump and all of his policies and everything like that. Go ahead, hit next.
Okay, so question 4, we're asking, how do stock prices react to macroeconomic events such as inflation and interest rates? So to get an idea of how exactly inflation and interest rate individually affects the prices, I created a linear regression model showing, and as you can see from the graphs, there's not much that can be determined based off of the interest rate and the inflation rate. Yeah, so then I trained in a RIMA model where I used a log return method for over 1 year period to create a prediction of the future prices. And the great degree of projected stock prices variability is demonstrated by the forecasted range is what it confidence interval. Despite this fluctuation, the model shows like a previous finding that interest rates and inflation have no discernible impact on stock prices. Yeah, next.
Okay, so our last question was whether or not we could try to predict future trading volumes based on previous data that we've had. So the two different machine learning approaches we tried to go for was linear regression, because it is a good baseline model and it is able to capture linear relationships like simply, and also random forest regressor as another model if linear regression did not turn out too well, because it is able to capture nonlinear patterns within the model. So the features that we had currently were not sufficient enough to solve this problem, because the data set only had the close, the high, the low, the open, and the volume, and we're trying to like predict the volume, right? So close, high, low, and open were too correlated to each other when putting them on a correlation matrix. So we feature engineered a couple of new features. So we created a price range feature which is just the high minus the low. We created a lag volume feature. This row, like this makes it so all the rows have the previous day volume. We have a lag 2 volume. This makes it so each row has the volume from 2 days before. And we have the rolling mean close. So this is the 5-day rolling average of the close prices. We also tried a couple of other features like rolling volume and rolling mean volume, but they were dropped because they were too closely correlated to other features in our correlation matrix. And we are predicting the log volume because the volume is in like the billions, so we wanted to ensure the predicted number is not too large and that it is actually readable. So if you want to take a look on the right of the correlation matrix, typically you don't want anything to be over about like 0.8 to correlation. Lag volume and lag 2 volume were pretty closely correlated, 0.75. Decided to keep it in there because it did boost our results a little bit though. All right, next slide. Okay, so with our linear regression model, we got a mean squared error of about like 0.023, R squared score of 0.62, but our cross-validation score is 0.38. So cross-validation score pretty much takes the R squared score between different time periods in your data set. So you can see on the training data, it has an R squared score of 0.62. I mean, sorry, the testing data, which is like, all right. But when you look at all of the testing data, it is pretty much not doing very well after folds 3, 4, and 5. Presumably because after the 2022 market crash, less people wanted to trade stocks, understandably. So just less people in general traded during then. So it's not a very linear relationship there. So we think that's why that is struggling. Okay, go next. Now we also decided to do random forest regressor, and random forest regressor actually performed considerably better than linear regression across all folds. So it has an R-squared score of 0.702, mean square error of 0.018, cross-validation score of 0.722, and it generalizes pretty well. It captures about 70% of the variance in the volume. Pretty reasonable R-squared score across all the folds in our cross-validation. If you want to take a look on the right, everything's hovering between like 0.7 and 0.8. Some potential improvements we could do to try to help out like both the linear regression model and our random forest regressor. Maybe some more feature engineering. A feature that could label the market crash time period might be helpful. Some more data instead of just like the last 5 years, maybe it'll be like the last 10 or the last 15. This would be a little bit weird because we're trying to capture like just how the like pandemic has affected the stock market. But we could also try to prevent overfitting like what it was doing in our linear regression model, where it was overfitting to the second fold by using some regularization techniques such as lasso regression or ridge regression. And that is about it. Thank you very much for listening to our presentation.